My name is Savoy Chocho, and working together with the educational team at the Zambia Institute of Marketing, I will show you how students could have approached questions in this paper. I'm going to start with question 1, and in this video I'll restrict myself to question 1. In the next video I'm going to get to question 2, question 3, and so on and so forth. And let's get straight to it. Question 1 reads as follows. Which of the following are books of prime entry? And we've been given a number of them. We've been given there's the purchase book. The purchase day book is a book of original entry. Then there is also the cash book. The cash book, yes, is a book of original entry. Original entry or prime entry is the same thing. And then there's the purchases day book, yes, and the purchases day book is also a book of prime entry. The ledger, the general ledger, is not a prime entry book, and therefore, let's see. Is the answer going to be A? A reads what? That is 1 and 2 and 3. The answer is 1, 2, and 3. Because this one is not a book of prime entry. No, it is not. So we don't even have to go any further. The answer is A. We move on to question 1.2, and it reads as follows. A trader's net profit for the year may be computed by using which of the following formula? Or is it formulae? All right, so we have them here. The first one is that opening capital plus drawings, less capital introduced, less closing. No, it's not the one, because there is already an existing formula with regards to this one, and the formula is that closing capital, there's closing capital, then to this you add drawings, then you subtract capital introduced. This is like, for example, in the course of the business, you have a business, then you get another 20,000 kwacha and add into the business. That is capital introduced. Then you are going to less opening capital. So there's a formula, it already exists. And if you look carefully, this particular formula right over here is somewhere here. Is it B? Closing capital plus drawings, less capital introduced, less yes. So we know that the answer then is B, because there's a formula that already exists. You just need to know the formula. We move on to question 1.3. This one. What does it say? It says, in which book of prime entry will a business record debit notes in respect of goods which have been sent back to the supplier? So the issue here is that you as a business, you buy something, you purchase, okay, because you sent back to supply. So you send it back, you buy something from them, and you send it back for whatever reason. It could be that it may have been faulty. It could be that the product may not have been the quality or the description that you had originally intended. So we are being given options, as options are given all the time. A, is it going to be the sales returns day book? The sales returns day book, no, because it's not a sale on our part, but it's a purchase. So we're actually just looking for purchase. If you go through the answer, cash book, obviously no. The purchase returns day book, correct. This one is the answer, because we purchased, as we are told. Remember, notice that we have sent back to the supplier what we bought from them, and so We purchased, then we return. And that is how come it is the purchase return label. Question number 1.4. 1.4. A trial balance is made up of a list of debit balances and credit balances. Which of the following statements is correct? A. Assets are represented by debit balances. B. Every debit balance represents an expense. C. Liabilities are represented by debit balances. And D. Income is included in the list of debit balances. Interesting. Now, if you look at the question, let me just scroll down. Question number two. Question number two is actually asking students to redraft. It's asking students to redraft the trial balance. And this is the video that I'm going to do next is going to cover this one. It's important that you know what a trial balance is and the contents of a trial balance, or rather how information is placed in a trial balance, because you will get questions around that. It is also just an important topic, so you need to know. For a trial balance, there is debits, D, that's D, right? There's debits and there's credits. So these options then, it's asking us, what is it that is true about the trial balance? That assets are represented by debit balance. Is this where we put our assets? Like car, like cash? Yes. This is where assets are going to be registered. Assets are not registered this side. Assets are registered this side. Every debit, this one, I'm reading this one. Every debit balance represents an expense. This is not correct. So far, this is correct. Liabilities are represented by debit balances. This is not true. Liabilities, like a loan, are represented on the credit side. Income is included on the debit balances. This is this one I'm reading. No, income, like revenue, is on the credit side. So then we know that the answer to this particular question is A. That assets are represented by debit balances. We proceed. Where are we? Scroll too fast. Question number 1.5. 1.5. What is the purpose of charging depreciation in accounts? Depreciation. Remember that depreciation is the loss of value of an asset, okay? An asset over a specific period of time. Specific period of time. Whenever you're talking about depreciation, there will be an element of time. It's very important. There will be an element of time. So even in the answer, you can get an idea just by knowing what depreciation is. So now the question is not asking why there is depreciation of assets. It's asking what is the purpose of charging depreciation in accounts, of recording these particular accounts. A, to ensure that funds are available for the eventual replacement of the asset. This is not true. You don't depreciate to ensure that there's funds available. So already we know that this answer is wrong. B, to reduce the cost of the asset in the statement of financial position to its estimated market value. Did you see what just happened? My screen just went hey-ho. So let me just change that a bit. Let me just correct that. Okay. I'll read that again. Okay. To reduce the cost of the asset in the statement of financial position to its estimated market value. No, it sounds correct, but this is not the reason why you charge depreciation in accounts. This one I indicated no. This one I indicated no. It can't be. Okay. C, to account for the wearing out of assets over its lifetime. This makes sense, but it's not the reason exactly why we do it. It can be one of them, but not the core one, especially that we've been given options. But then there's this one, to allocate the cost of non-current assets over the accounting period expected to benefit from its use. Remember that I did mention that when it comes to depreciation, there's an element of time. And for sure, what we depreciate are non-current assets. This answer is way much more specific than the others, and therefore the correct answer out of these options is D. Let's move on. Question 1.6. 1.6. Which of the following formulae represents the prime costs? Which of the following formulae represents the prime cost? I encourage you to check out my YouTube channel. My YouTube channel is called Captain 37. Captain 37, just Captain 37, just like this. There you will find a number of videos where I cover basic finance and other subjects. And this particular topic falls under what is known as manufacturing accounts. Manufacturing accounts. You will find a video on manufacturing accounts. If you don't find, let me know. I'll send you the link to that particular video. And the manufacturing account is broken down into different phases, into different parts. One of the parts that constitutes the manufacturing account is what are known as prime costs. And prime costs are simply a combination or a total of all direct costs. So all the direct costs put together give you what is known as your prime costs. Direct costs. So with this knowledge, you can look through the answers because all that you need now is direct cost. So here there's direct cost, direct, indirect. So we know that already this is incorrect because there's indirect here. B, direct material, less direct, less direct. We know that this is not correct because with prime cost, it's about adding, not subtracting. There's no subtraction whatsoever. Then C, indirect costs, already it's wrong because we know that we are dealing with direct costs. We're left with one option, which is direct material plus direct labor plus direct expenses, and this is the answer. Let's proceed to question number 1.7. This one. Which of the following methods is used to calculate the cash flow from operating activities in the cash flow statement? Okay. Which of the following methods is used to calculate the cash flows from operating activities in the cash flow statement? My Facebook page is Marketing Study in Zambia. Check it up. There's lots of notes there. There's guidance notes. There's information that can help you as you continue in your studies. Let me read this question once more. Which of the following methods is used to calculate the cash flows from operating activities in the cash flow statement? A, direct method. B, straight line method. C, reducing balance method. And D, cash flow method. Now, I can tell you for a fact that this one is not correct and this one is not correct. The straight line method is a method that is used to calculate depreciation. Also, this is another method that is used to calculate depreciation. So we are only left with two options. There's A and there's D. Now, when it comes to cash flow calculations as a result of operating activities, there are two ways of doing those calculations. There's the direct method and the indirect method. And we have already been told here that there's a direct method. So without even going into explanations of what the direct method is and what the indirect method is, we know for a fact then that the answer to this particular question is A. Let's move on to 1.8, right? Yes, 1.8. 1.8. What does a master budget comprise? Master means someone who has everything, right? He's my master. He knows everything. Master comprises of everything. Master cassette, master CD. Master is like the best. It comprises of everything. Just by that illustration, you can even tell that here the answer is B. What does B say? B is saying that the master budget comprises of budgeted cash flow, budgeted statement of profit or loss, and budgeted statement of financial position. The master contains everything. That is what a master budget is. And this is the answer, B. Let's move to 1.9. 1.9 is over here. The following statements relate to fixed budgets and flexible budgets. This is a very common topic. You need to know the difference between a fixed budget and a flexible budget. What is it about these particular budgets, right? So there's one here that if production levels far exceed those anticipated, relying on a fixed budget is likely to result in massive variances. Variance is the difference between what you budgeted and what you actually incur. In fact, variances is a very important topic that you need to know, and I will run you through that topic eventually. So the first on the list is this one that I've just highlighted, that if production levels far exceed those anticipated, relying on a fixed budget is likely to result in massive variances. Okay, we've taken note of that. Then there is two, that flexible budgets assist management control by providing dynamic, comparable information. Okay, we've taken note of that too. We're supposed to take note because the real question then comes here to ask us which statements are true. Statements coming from where? Statements from these three. So we need to take note of them. The first one was that the first one, which is this one, we've taken note of that, right? That if production levels far exceed those anticipated, relying on a fixed budget is likely to result in massive variances. Not taken. Two, flexible budgets assist management control by providing dynamic, comparable information. And three, flexible budgets are always superior to fixed budgets. This is not true. This is not true, because you can't say this budget is better than this budget. The approaches or the concept are different, and each one of them has got an application. So I know for a fact by understanding that three is not going to go. That three is not there. Now, so then let's look which statements relate to the following statements. So now we're going to look at the answers, the possible answers. Which statements, which I'm here, okay? Which statements are true? One only. Let's go to one. What does one say? This one. This statement is true. This statement is true. But it is not the only statement that is true, because D, let's see. What does B say? Not D. What does B say? Oh, or is it B? Not B, but two. Two. Flexible budgets assist management control. This is correct too. That's correct. So this cannot be then correct, because it is not only one only. B, this one and three only. We know that three, I already indicated that three was not correct, right? I already noted that here that three is not correct. So as long as there's going to be three that's going to be indicated here, then it is not correct. Not correct. Then D says D says one and two. Go back, let's just quickly check. Yes, remember I ticked one and two. And therefore, the answer to this one is D. Let's now deal with this one, which is 1.10. In decision making, costs which need to be considered are said to be relevant costs. Which of the following are characteristics associated with relevant costs? And yes, relevant costs are costs that result in an impact on the cash flow of a business. For example, as a business, you may be planning to have a discount promotion that you'll be running in the month of September. You are going to incur relevant costs, because there's going to be an impact on your cash flow. Now, this question is asking the characteristics associated with relevant costs. Okay, so number one, are they future costs? Are relevant costs future costs? Are they unavoidable? Are they incremental? Or are they differentiation costs? Which one applies? Now, the ones that apply, future costs, relevant costs, future costs, yes, they're future costs. Look at the example that I told you, that you're going to run a promotional campaign where you're going to reduce on the price of your product. You are going to, so it is a future undertaking. So that is one of them, that it is a future undertaking. Are they avoidable? Are they avoidable? Which is unavoidable? Hmm. Are they unavoidable? Relevant costs. Are relevant costs unavoidable? You can avoid them. You can avoid. No. You can avoid certain costs. It's possible because you may partner with another business, and in partnering with another business, that other business may incur some of the costs that you would have incurred. So then, relevant costs are future costs, and they are avoidable costs. So this one, then we know. Boom, nope. Are they incremental? Are they incremental? Yes, they are incremental because they can increase. You decide to prolong your promotion, your costs are going to go up. It's incremental. And how about differentiation? Are they differentiation? Yes, they're going to differ all the time from one activity to another. Having said that, we now know that our answer is going to comprise of one, two, and one, two, not two, sorry, three, one, three, and five. Do we have this anywhere there? Let's check. Yes, we do. And the answer is C. So these are the answers that would have given you full marks to question one. what you can do is just go through this again at your own time so that you understand. That is more important. Together with the team at Zim, the educational team, we will make a few other videos to guide you so that you know how to attempt these kind of questions. My name is Savoy Chocho. I encourage you to check out my Facebook page, which is Marketing Study in Zambia. My YouTube channel is Captain 37. Subscribe and see you in the next video. Goodbye.